This week, to be closer to China, Fintech, short for financial technology, uses big data and artificial intelligence in the design and delivery of financial services. With high levels of internet and mobile penetration, China is the world's largest and most developed retail e-commerce market.
So Fintech in China, I think China is actually leading the world.
Leveraging Fintech, China is now developing a nationwide social credit system.
They use the big data analytics to analyze your data.
With massive data being collected constantly to generate a social credit score for every individual, will personal privacy be affected? This week, be closer to China. Fintech, short for financial technology, is set to transform financial services, disrupting the financial service industry as we know it. Fintech employs innovative technologies in the design and delivery of financial services, including digital payments, online banking, peer-to-peer lending, all energized by artificial intelligence, AI, and big data. With high levels of internet and mobile penetration, China is already the world's largest and most developed retail e-commerce market, accounting for nearly half of global digital retail sales. Leveraging Fintech, China is now developing a nationwide social credit system, which is expected to be operational by 2020, and will assign a social credit score to every citizen and business in China based on its financial and social behavior. Fintech and China's social credit system each has its benefits and challenges. Does each also have risks and dangers? Will Fintech increase financial system risk? Will social credit affect personal privacy? Broadly, can Fintech and social credit complement each other? Can they work together for the common good? Fintech and social credit are the future, bringing us closer to China. In today's China, a QR code is a must-have for retail businesses. From grand department stores to food stands on street corners, QR codes are everywhere. By scanning the codes, people can pay for almost anything, making things easier. But QR codes also make things easier for scammers. They are so accessible that a simple scanning of an unidentified barcode can lead to a large loss of money or massive personal information leak. QR codes and their popularity exemplify the revolutionary changes brought about by financial technology, Fintech, that seeks to automate and improve the delivery and use of financial services. It is well acknowledged that, in China, Fintech is enhancing financial industry, upgrading its specific and economic transformation in general. Now, while Chinese people enjoy better financial products and services, concerns are also rising on their risks and challenges. What is the current state of Fintech in China? What are Fintech's benefits and risks? Addressing the risks, what is the regulator's strategy? What is the current state of Fintech in China?
So Fintech in China, I think China is actually leading the world. I think the first place we've really got to look at is, what do we mean by Fintech? I think quite often people get a little bit confused. For me, Fintech is about technology and financial services. So it's about how the participants in the market will use technology to carry out what are sort of ordinary day-to-day financial services transactions. Sometimes I think the best kept secret. China really leads the way. It has the most developed payments ecosystem. It has the most developed e-commerce ecosystem. And I think as a result of that, Fintech players, so people who build technology to help in financial services and to make financial services more efficient, have far more opportunities to be able to work within the ecosystem.
Fintech has been growing in China for a while, and it's fair to say that we have seen positive progress in certain areas. Let's look at the several components of Fintech. First, there are data, including conventional structured data and increasingly large quantities of unstructured data. We should calculate all the data as a whole. The second component of fintech is artificial intelligence. AI is based heavily on data and involves two key points: algorithm and computing power. The third component of fintech is interconnection technology, which we can see from two aspects: mobile internet and the Internet of Things. Needless to say, China leads the world in mobile internet with its huge market of cell phones. All information and further application of this information rapidly reaches users at a very low cost. The fourth component of fintech involves blockchain and distributed computation. As far as I know, in this regard, China has caught up to the world level. To get results from the blockchain technology, huge quantities of computing requires huge consumption of electricity. Many global experts are drawn to China due to the relatively rich resources of electricity in many parts of China. The fifth component is security technology, such as facial recognition, and China is doing well in this aspect.
Fintech is developing with extraordinary speed in China. What are the drivers?
The main thing is we are still an emerging market. There are a lot of needs in the market for financing, and the traditional banking system is not super well established compared to the developed countries. So the internal demand and the supply for financing is a driving force of the development of this industry. And on top of that, I should also mention two things: the technological innovations and the government guidance. Those are very important drivers as well.
I think what has happened is that, the way the Chinese economy has developed, we kind of missed a large part of what happened in the Western world, in that we moved almost straight from a physical economy into an e-economy, so into an e-commerce-based platform. So for me, when shopping went online, when transactions went online, it then necessitated the fact that you needed to have electronic payment. And so e-commerce, I think, has been the fundamental driver for the change in the financial services ecosystem and been a fundamental enabler for fintech organizations to be able to change the way traditional transactions were processed.
How to make finance truly inclusive? What is the key?
The banking industry in China originally, they're not super developed compared to some very, very much established countries. Here we have a lot of fintech innovations. For instance, now you can do banking on your cell phone. You can do loans and investments on P2P platforms. So those financial technology helps the finance industry to be more inclusive.
From my perspective, fintech has actually benefited small and medium-sized financial enterprises the most. Moreover, for the general public, inclusive finance means broadening the accessibility of financial services. First of all, the use of fintech has lowered the threshold of obtaining loans. Why was it more difficult for SMEs to obtain loans in the past? Because certain thresholds were too high for them. For example, many startups struggle to provide a complete list of balance sheets, profit and cash flow statements, information that the traditional financial system requires. Without such statements, it's relatively rare for the system to grant financial services to the startups. Secondly, thanks to the accessibility provided by fintech and interconnection, somewhat mysterious financial services are now more accessible for most ordinary people. Thirdly, the reason why traditional banks are reluctant to grant loans to medium-sized and small enterprises is because the former see a low credit or can't even verify the credit from the latter. Fintech has solved such problems on a large scale. In short, the financial problems of cost, credit, and accessibility have been solved greatly by fintech. As a result, we've seen inclusive finance grow significantly in recent years in China. Obtaining loans now is much less of a concern for SMEs, especially for private enterprises.
The benefit of fintech is obvious. What are the risks?
I worry about the platforms. They are investing in bad projects. And then the projects do not pay off, and then they don't have the money to repay those people who loan the money to them. I think that's the biggest risk. And the risk management is also very, very difficult for P2P platforms. Why? Because we don't have a lot of the information of individual borrowers. We don't have their credit profile. And of course, when you invest in, remember, the P2P platforms, for instance, they give very high return. Now, when you take a high return, you kind of know you are taking high risk too, right? Sometimes it's excessive risk taking that's destroying the wealth of investors and the platform.
The other side involves regulation. Though new information is put to use and sold by fintech, regulators may not even fully understand these consequent financial products and services. We have an agenda to transform the regulation system. That is to say, regulation improvement should go in tandem with development of the financial industry. Fintech used in financial industries should also get applied in regulations. Obviously, however, regulations have failed to keep pace. The regulatory authorities aren't knowledgeable enough about the problems emerging through the use of fintech. I think we should not exaggerate the risks of fintech application. It's inappropriate to conclude that the risks are brought only by the use of fintech, or they are just problems of the enterprise and market. In fact, the main cause is the ill-prepared regulators have failed to update regulation concepts, strategies, and tools. Generally speaking, I believe fintech in China does more good than harm.
There are new forms of risk that fintech brings to China's financial system. So how can public policy balance fintech's risks with its benefits? What is the regulator's strategy?
So let me, again, give you an overview of what they did, the regulators. I returned to China from United States about 2 years ago. And over the past 2.5 years, I have been learning actively about Chinese regulators. And I have interest in this area because when I was in the United States, I did some research for the SEC, and we look at the effectiveness of many regulation changes. So now let me tell you what happened in P2P platforms, the industry. Like I said at the beginning, there are 3 stages at this point. The first stage is like the wild growing, everybody wants to jump on P2P platforms. So that's where the growth is huge. And at this point, at the first stage, what did the regulators do? Well, on one side, they clearly see the benefits of the P2P platforms, okay? As we mentioned earlier, it's helping the financial inclusiveness. It's complementing the banking system. So at that point, at first stage, the government has been quite encouraging of financial innovations, okay? Because again, the benefits are higher than the costs, so we're encouraging. Now, when we move on to the second stage is where frauds start to appear. People start to lose money, and there are bubbles in the industry. What did the government do? So starting from 2016, the regulators start to standardize the market. Meaning what? Meaning they start to build professional associations of P2P platforms. And then the idea is they want the practice, the industry, to follow some rules. Okay, and during this process, the investing community and the borrowers start to get the idea that the industry will consolidate to some point. Okay, and then the later stage, starting from last year, is regular regulation, meaning that after standardization, when the industry and the investors are more or less ready for it, we start to put like relatively more strict regulation on the development. People might say that compared to the developed countries like UK, US, and other places, Chinese regulators are doing a lot to guide the market this way or the other way. We are still an emerging market. Like I said, the market is not mature itself, so the guidance from the regulators, to me, I think is quite beneficial. And I think the same pattern might work for most of the emerging countries.
To help prevent financial risk and to offer better financial services, China's National People's Congress, NPC, and the Chinese People's Political Consultative Conference, CPPCC, proposed the building of China's concept of credit in 2002. In 2014, the Chinese government decided to establish a social credit system that will give all of its almost 1.4 billion residents a social credit score. Once this system is completed in 2020, every Chinese resident will have a searchable file of combined data that will generate his or her social credit score. As the government is now working to unify local databases, data-driven Fintech has established itself as pivotal to the construction of a social credit system. How can Fintech facilitate China's social credit system, and how together can they help prevent financial risks? How can Fintech and social credit be complementary and reinforce each other? China is now building a social credit system. What is it? How does it work?
Let me first tell you that a social credit system, right? What does that mean? To me, in my opinion, what it means is everybody, every individual, every enterprise, small or large, you have your credit profile, okay? But in China, that information is not, it's not very complete. So, in developed countries, every individual might have a credit score. In China, a substantial amount of individuals, they don't have the credit score. So it's very important. Again, the simplest financing behavior is borrow money and invest money. And to do that, you have to know who's your counterparty. You have to know what's the probability of the counterparty defaulting, whether they're going to pay you back. That's very important. And how do you get that information? You have to have a credit profile for your counterparty. So if you don't have that, a lot of basic finance activities will be restrained. It cannot be happening.
I think at the end, what we're looking, I think, for a good social credit score, it needs to be truly reflective of the behaviors of individuals. It doesn't need to be something which is a policing mechanism. It needs to be supportive of the role that individuals and organizations play in the economy. It needs to reflect their buying patterns, it needs to reflect their spending patterns, it needs to reflect their saving patterns, it needs to reflect their lifestyle patterns, in order to be able to get a much better understanding of people's capacity to repay and then their willingness to repay. And I learned a lesson very early on in my life that, lending money is very, very easy. The hard thing is getting it back. And so for me, what a good social credit score system does is it helps those people who lend money to understand how to get it back. And the quicker you can get it back, the more propensity you have to lend. And so it creates liquidity in the economy, it creates jobs, it creates incentives, and it creates prosperity.
How does Fintech enable China's social credit system? What's the role of Fintech in constructing a social credit system?
So let me start with what Fintech can do to help. Okay, in the past, how come my grandfather, he was a rice farmer. He never had a bank account. Okay, well, he passed away a few years ago. But my uncles, my aunts, they're still rice farmers. They don't necessarily have banking cards. They don't. Okay, so why they don't? Well, because they never went to the bank and established a loan. By the way, even if they went to the bank, they might not get the loan in the first place. So what happened is, in the past, when we built the social credit system, you have to have loans, other credit activities to be included. And people look at the performance of your past credit events, and then they tell your credit score. Now, there's a large population, farming population in China. They most likely are not interacting with the banks in their life, and those people don't have credit history. The good thing about Fintech, well, is, there's development of two things, I think. Three things, actually. That's really helpful. One is the mobile, network. Now, everybody, it doesn't matter whether you borrow from the bank, you are very likely have a phone. And then when you have a phone, you have activities on the phone. Okay, so first, the mobile network is very important, and then second thing we talk about is big data analytics. So with the big data analytics, stuff, we can come up with a credit score, even though you are not interacting with the banks. Meaning what? Meaning the population that's not covered by the bank initially. Now, because they have online activities, we can still give them some credit score. And they move on to provide services on what kind of things you want to invest, what kind of things you want to borrow.
We've talked about how the development of the social credit system is completely dependent upon fintech and big data. That's obvious. But how about the reverse? If, as China develops its social credit system, what impact will that have on the development of fintech?
Given its huge demand for fintech, the establishment of China's social credit system will surely be a catalyst for the use of fintech, allowing it to grow faster and expand more widely. I felt this strongly during the 2018 World Internet Conference. The credit system was in such a great demand at all levels and in all areas that it also drives fintech technicians to innovate further. For those fintech technicians who focus purely on the technology, they may fail to see other new demands emerging. New demands require technicians to create new algorithms to depict new ideas, to expand into new areas, to calculate new sets of data, and to fix problems. Social credit system establishment and fintech innovation are mutually reinforcing trends.
The social credit system, there's been a lot of commentary on whether it's good or whether it's bad. Actually, China, because of its relatively short economic history, really people don't have a default history. So they don't have a borrowing history. They don't have a history of being online, borrowing money, repaying money. So they don't really have what in the Western world most people have in terms of credit score. So you need to look at different things that would indicate whether or not you can repay and whether you will repay. And I think the really good thing about a social credit score is that it allows far more data to be collected, far more data to be analyzed, and for those who believe that the data is solid and sound, they can carry out a different level of analysis in order to be able to make loans, to provide finance, to support investment decisions, etc. And so with all of that data, you get a better quality, you potentially get a better quality decision. The challenge is whether the data is actually real, whether it's safe, and whether it truly reflects people's behavior. And I think where there's a lot more work that needs to be done is in managing the integrity of the data. Because really nobody knows what's being collected, nobody really knows how it's being analyzed, nobody really knows then what the outcome is. And I think there's a general level of skepticism as to whether or not it really adds any value or whether it's more just a policing mechanism for behavior.
According to reports in the foreign media, the Chinese social credit rating is a product of combining public and private data sources. Public sources include criminal records and court data, traffic cameras and pedestrian monitoring using vehicle and facial ID, checking for traffic violations, travel patterns, for example, going abroad, regular visits to parents. Private sources include chat and email data, internet shopping information, loan and debt information, especially liquidity and default risk, smart devices such as phone location and other sensor data. Algorithms pull and analyze the data to generate a single credit score for every individual. And as a result of that score, he or she will be rewarded or punished. There is a worrying question. With massive and comprehensive data being collected constantly, how will social credit affect personal privacy? Are there concerns about what happens to society? I mean, we have these issues in the U.S. and other countries in terms of privacy, in terms of ownership of your own information. Are we in a world now where maybe China's a pioneer, but everybody will be following the same thing, where we're all giving up privacy, and that's just a good that was a good of the earlier centuries and is no longer a good of the 21st and subsequent centuries? We all just give it up. Is that part of the trade?
Fintech has been used to collect all sorts of credit information, even items you'd hardly expect to be collected. You may feel like an utterly transparent being because everything about you can be collected. Privacy and ethical issues are all involved. So I cannot agree with you more. It is a problem. We must address it well. I'm afraid China faces more trouble in this aspect, since privacy protection here is not as stringent or as valued as much as it is in Western countries. In the future, we should communicate more with developed countries to jointly tackle this yet-to-be-addressed problem. Different issues are emphasized at different stages of development. There is no doubt that internet innovations have brought negative impacts to our society. If the Chinese government is to solve this problem, I recall an old Chinese saying, "We cannot give up eating for fear of choking." A wise policy should strike a balance.
As you know, China's burgeoning social credit system has been subject to scrutiny and criticism in Western media. From your perspective, what are the criticisms that some Westerners have of China's social credit system, and how do you respond?
I understand they have concerns. They worry about having one central credit agent. First, going to create a monopoly. Second, are they going to be responsible to private data? And third, can they provide efficient services to the community? You know, China is a developing market, emerging market. We have a lot of things to learn from other countries. The good thing is, so far from what I can see for the past 2.5 years, I think the Chinese regulators have been quite open-minded to learn from other countries. But given the rapid growth of everything in China, things constantly change, which can be problematic. But I still see that we have a very steady, we have the drive to develop the country to a better future, not a worse future.
Chinese fintech is evolving with incredible speed, transforming financial services and altering society. Daily transactions are suddenly electronic with cash nowhere in sight. In such a new financial world, a fair and transparent credit system must assure people of its safety and reliability. To this end, major Chinese enterprises, especially Alibaba Alipay and Tencent WeChat, focus intensely on data collection and analysis, capturing social behaviors via public data and private databases, as well as traditional financial transactions and debt records. China, with its huge population, provides a wealth of data, but it still lags in developing effective algorithms to use the data. Fintech facilitates the construction of a social credit system in 3 ways. First, it adds dimensions to current data, such as social media activity, locations, and preferences. Second, it enables new credit services. Third, it brings credit services to lower-income individuals and to small and medium-sized businesses, thereby helping to make finance more inclusive. In return, social credit's vast data forces fintech to up its algorithmic game. The challenges are evident. Fintech must be regulated because its power is startling and its speed stunning. Big data must serve the whole society, not monopolized by an oligarchy of enterprises. The big question haunts: what is the trade-off between public security and personal privacy? That's Closer to China.